Have you ever stopped to think about what money really is, where its value comes from, or how it actually works? Most people find the idea of money confusing and mysterious, so we don't often talk about where it comes from or how it's created. We just accept money as something that's always been around, almost like it's out of our control. But what exactly is money? How does it hold value? Is it just the numbers you see in your bank account or the credit limit on your credit card? Does it include things like stocks, houses, or your personal belongings? Or is money simply your ability to buy things? Is money valuable just because we all believe it is? The truth is, understanding money isn't as complicated as it seems. Once you learn a few basic ideas, it all starts to make sense. So stick with me. If we look back through history, people have used all kinds of things as money: grains, shells, beads, livestock, different kinds of metals, and now even digital currencies like Bitcoin. So can anything be money as long as people trust it, or is there more to the story? Let's find out. Money is really just a way for us to store and measure value of goods and things so we can trade with each other. In the past, people used things like beads and shells because they were easy to carry around, but the problem was, not everyone agreed they were valuable. That's why they didn't last as reliable money. For example, livestock and grain were more valuable because everyone could personally use them then, but they were a hassle to transport or trade. Eventually, gold became the go-to choice to universally represent a value, as it gained acceptance from many quarters. So how did gold become the preferred choice? The problem was, carrying your life savings around to buy a cow or whatever was risky and cumbersome, but metals like gold is not perishable, which is more than one can say for cows. By melting and reforming gold, they can be easily divided into smaller units and conveniently used for purchases of minor items. Did you know goldsmiths were the first bankers? That's where they came in. Since goldsmiths worked with gold and had strong, secure vaults to store their own gold, most people chose to keep their gold with them. Not everyone could build or afford their own vault, so naturally people trusted goldsmiths to keep their gold safe. If you took your gold to a goldsmith, they'd keep it safe in their vault and give you a receipt showing how much you deposited. This receipt acted like an IOU, like a contract, proving you owned that amount of gold and could get it back whenever you wanted by furnishing the receipt. Over time, people started using these receipts to trade, since everyone trusted they were backed by real gold stored with the goldsmith. Think of it like a movie ticket. But instead of a blockbuster film, it represented your economic future. Now here's where things get interesting. People began to realize that rather than repeatedly withdrawing and depositing heavy and cumbersome gold for every transaction, it was much easier to simply exchange the receipts or IOUs backed by the gold stored in the vault. This method was clearly far more convenient. After all, that paper receipt stood for real gold kept safely in a vault by the goldsmiths, something physical that could be claimed at any time, if not just an ordinary piece of paper. This concept eventually developed into what we now know as an IOU. An IOU, short for IOU, is a written promise to repay a specific amount of money or goods. In a sense, money itself is a special type of IOU issued by the government, with some extra features. That's why money created by central banks is usually listed as a liability on their balance sheets, but the goldsmith-issued paper receipts, or IOU, is same as a general receipt? Not quite. A receipt is proof of a transaction showing that something has been received. An IOU is basically a written promise that you'll pay someone back in the future. It's like saying, "Hey, I owe you this amount, and I guarantee I'll pay you back later." The seed of a truly terrible, brilliant idea had been planted. Today, we use fiat currency money that has value because the government says it does or promises that it guarantees, not because it's backed by gold or anything that is already stored or held anywhere. Otherwise, to say fiat money has a value because people put their faith on the government ability to honor and stabilize its value. So we can say, it is backed by nothing but government's promise. That is how fiat money works. Let's get back to the story of gold. Over time, goldsmiths realized something clever, though a bit sneaky. They were in charge of keeping people's gold safe and giving out paper receipts as proof of each deposit. But since hardly anyone came to collect all their gold at once, And because there was no one checking to make sure the receipts matched the actual gold in the vault, the goldsmiths saw an opportunity. They quietly started handing out more paper receipts than the amount of gold they actually had. In other words, they created extra receipts that weren't backed by real gold. These new receipts looked just like the real ones, so no one could tell the difference. People continued to use these receipts as money, trusting they could be traded for gold if needed. The goldsmiths then lent out these extra receipts and charged interest, basically creating new money out of thin air. I mean literally and figuratively from thin air or nothing. The only any cost there was the paper to make the receipt itself. This trick made the goldsmiths, who were the early bankers, very rich. This indistinguishability allowed the goldsmiths now the central banks to circulate or print more notes than they had or have gold or anything of equal worth, effectively creating money out of thin air. I mean literally out of thin air. Imagine there's a vault full of gold, and someone is printing paper notes that claim to represent gold stored in that vault. Some of these notes are actually backed by real gold, but others aren't backed by anything at all. People don't realize the difference and treat all the notes as if they're equally valuable. This system worked because at the time, there were no regulators or independent auditors to check if the amount of paper notes matched the gold in the vault. No one was there to warn the public or challenge their trust in these paper notes. Today, it's well known that central banks create money, often not by printing physical bills, but by simply adding numbers to accounts electronically. This increases the total amount of money in the economy, even though it isn't always backed by something tangible like gold. It was like money magicians pulling a rabbit out of nothing, creating wealth out of mere paper receipts or IOUs, backed by nothing but the promise of value. The whole operation almost same as counterfeiting money by criminal elements in the society. The value of things like money and stocks relies heavily on people's trust. This trust is much like the faith people have in religion, whether it's belief in gods, prophets, or sacred texts. As long as people continue to believe, even if that belief sometimes rests on shaky ground, the value of these things remains steady. Philosopher Friedrich Nietzsche observed that most people prefer to hold on to their comforting beliefs and don't want those beliefs challenged or shattered unless absolutely necessary. This tendency has helped maintain confidence in modern fiat money, even as governments print more of it and inflation slowly reduces its real worth. Bitcoin was created to address this issue by having a fixed supply, unlike regular money that can be printed endlessly. The idea is that scarcity could help preserve value and offer protection against inflation. However, even Bitcoin's value ultimately depends on people's trust and collective belief, and it faces its own unique challenges, including price volatility and speculation. In short, whether it's dollars, stocks, or cryptocurrencies, the foundation of value is trust, a kind of shared faith that can be surprisingly fragile. And despite all the complexities and potential pitfalls over the time, public continues to trust and keep their faith in this intricate system of money creation. Money is always evolving. In current time, just like the goldsmiths then, central banks created money out of nothing. In the future, Bitcoin or any other physical or virtual thing may become a popular form of money as long as people are convinced to place their faith in them. To quickly recap, magic money creation formula. As the entrepreneurial goldsmiths noticed something peculiar or had an insight, a diabolical one maybe. That is, people rarely withdrew all their gold at once, so they started discreetly slipping a few extra receipts into circulation, loaning them out to eager borrowers, with interest of course, earning interest for free. Suddenly, they weren't just guardians of gold, they were creators of credit, or can we say, creators of money. People were content with just trading those receipts, as long as the illusion of those receipts backed by gold is intact, even when it wasn't, and confident that the gold was there if they needed it. These IOUs, backed by nothing but a pinky swear and the hope that no one would cash out all at once, were morphing into what we now call money and modern-day banking system. This, my friends, is the beginning of banking, and largely it's akin to controlled and managed counterfeiting of money, charging interest on that counterfeit money by banks legally sanctioned by governments. Before you rush to grab your pitchforks and storm Fort Knox or your central banks, keep in mind that, at least initially, the intentions weren't entirely malicious. The modern banking and monetary system, often criticized for its complexity and perceived flaws, is the product of centuries of human experimentation, adaptation, and at times, failure. Its origins are not rooted in outright malice, but rather in humanity's ongoing search for safer, more efficient ways to store value, facilitate trade, and manage risk. So by creating these new paper receipts or additional money or injecting more money, or IOUs, into the system, they actually, albeit unintentionally, were stimulating the economy. People were building businesses, buying sheep, living the high life, or at least a slightly less medieval life. The problem? This whole scheme relied on a delicate balance. Too much money creation could lead to inflation, aka the gradual erosion of faith and value in the IOU receipt or paper money. Like when that one loaf of bread suddenly cost 10 gold receipts. Too little, and the economy would stagnate. Like that time you waited for a carrier pigeon to deliver an important message. Spoiler alert, it never arrived. In the past, people could get away with printing more fake receipts as money because no one was watching closely to make sure the number of receipts matched the real gold in the vault. The whole setup was kept out of sight, so most people didn't notice anything unusual. Nowadays, mode of operation is pretty similar. That is, money is created out of nothing, but things are much more transparent. If you pay attention, you can see how the system works. There aren't really any hidden tricks anymore. People continue to believe in this intricate system of money creation and their money gods, in money temples like central banks across the world. It appears all people seemed to need was a motivation to work. The fake money and credit provided this nudge, driving them to create and build, helping the economy to flourish. Let's take a look at how money can actually be created seemingly out of nowhere by local banks, using something known as fractional reserve system in modern banking system. This is besides what is created by central banks via electronic credits. Enter the concept of fractional reserve banking. Imagine you deposit 10 gold coins or dollars into a bank. The bank doesn't just lock those coins away in a vault, never to be seen again. Instead, they keep a fraction of those coins, say 1 coin, as a reserve and lend out the remaining 9 coins or dollars to someone else. That borrower then deposits those 9 coins into their own bank, which again keeps a fraction and lends out the rest. This process repeats, creating more and more money in the system. Here's where it gets interesting. How do banks create money from nothing? Even though there's only 10 actual coins, the total amount of money in the system, our original coins plus all those loans, multiplies. This is because, on paper, your bank balance says you have 10 coins, and the borrower's bank balance says they have 9 coins or dollars, and so on. This multiplication of money is what we call the money supply. Let's break it down mathematically. If the reserve requirement is 10%, it can change based on the policy of the central bank. The money multiplier is 1 divided by the reserve ratio. This means that for every 10 coins or dollars deposited, the banking system can theoretically create 100 coins or dollars in total money supply. But why is this sometimes good for the economy? By increasing the money supply, banks can lend more, stimulating economic activity and growth. However, this system comes with its own set of risks. If everyone decided to withdraw their money at the same time, the bank wouldn't have enough actual coins to give everyone back their deposits. This is known as a bank run, and it's every banker's worst nightmare. The beauty and danger of fractional reserve banking lie in its ability to expand the economy by creating credit, but also its potential to cause financial crises if not managed properly. And this is why, as we'll see later, central banks and regulations become crucial to maintaining trust and stability in the financial system. So, fractional reserve banking is like a delicate dance, balancing the need to lend and grow with the need to maintain enough reserves to keep everyone's trust. And trust, as we'll explore, is the cornerstone of any banking system. Again, looking back at history, once the sleight of hand of money creation hand of money creation started to be known to people, everyone wanted to become a banker. Word spread faster than a bad case of the Black Plague. You could make a killing by lending out money you didn't actually have. So why not soon? Banks were popping up like mushrooms after a particularly damp fortnight. The goldsmiths, once pioneers, were now competing in a financial free-for-all. Governments, never ones to miss out on a sweet deal, realized they could get in on the action too. They started issuing their own form of IOUs, backed by the promise of future tax revenue. Because what's more trustworthy than a government's promise? What happens when too many people play banker? This is where things get really messy. With everyone and their pet monkey printing money, things got out of hand. Remember that delicate balance we talked about? Yeah, it was gone. Economic bubbles inflated and burst with depressing regularity, leaving a trail of bankrupt businesses and bewildered sheep herders in their wake. Something had to be done. The financial system needed an adult. Enter the central bank. Think of it as the hall monitor of the economy, tasked with keeping things relatively stable and preventing everyone from going full-on gold-hoarding goblin. What is full-on gold-hoarding goblin? What is the Federal Reserve? In the United States or central bank in any country, that hall monitor is the central bank, as it's affectionately known, the Fed in America or RBI in India, Banks England in UK, and so on. How did the Federal Reserve take control? Created in 1913 after a series of particularly nasty and crazy financial panics, we're looking at you, Panic of 1907, the Fed was tasked with being the lender of last resort, to be the lender of last resort. In other words, when things get chaotic and public and banks start to panic, the Fed steps in with extra cash, obviously from a thin air, to calm everyone down and restore confidence in the system. Think of the Fed as the cool-headed problem solver in a room full of worried bankers, ready to inject money and keep things running smoothly when it matters most. Their main job? To control the money supply and keep inflation in check and keep banks honest. No more printing money willy-nilly. The Fed was going to bring order to the chaos, like a stern librarian shushing a rowdy book club. But how do they actually do that? Well, it's a bit complicated and involves a lot of jargon, like open market operations and reserve requirements. But essentially, the Fed controls how much money banks have available to lend out. Think of it like this. The Fed is like a global air traffic controller. Too many planes, money in the sky, and you get congestion, inflation. Too few, and the skies are empty, leading to economic stagnation, recession. The Fed's job is to find that balance, ensuring smooth economic takeoffs and landings worldwide. Or at least that's the idea. His job is to find that balance, ensuring smooth economic takeoffs and landings worldwide. Or at least that's the idea. How does the Fed work its magic? Prepare to have your mind blown. The Fed doesn't actually print stacks of cash and airdrop them onto Wall Street, though that would be pretty cool. Instead, they create money electronically. They don't even have to print receipts or notes anymore, so just with a few clicks of a mouse and a few keystrokes on a computer, job is done. It's like magic, but with more zeros and fewer doves. Because of historical problems with inflation and social turmoil and disasters, there are rules that prevent the government from simply asking the Federal Reserve to create unlimited money for their own spending and projects. Instead, when the Fed wants to help the economy, it buys government bonds, basically government IOUs from banks, rather than directly from the government. But instead of paying with actual money, they simply credit the bank's account with newly created digital dollars, created out of nothing. Of course, poof! Money created out of thin air, like a financial rabbit out of a hat. This new money, now in the hands of banks, is free to be lent out to businesses and individuals, increasing the money supply, and, hopefully, stimulating the economy. It's a delicate balancing act, and the Fed has to be careful not to overdo it. Too much money creation can lead to inflation, and nobody wants to pay $100 for a gallon of milk, except maybe dairy farmers. So the next time you hear someone say, the government just prints money when they need it, you can set them straight. What secrets does the Fed hold? It's not quite that simple, but it's still pretty wild when you think about it. Money, as it turns out, is more of a shared illusion than a tangible thing. And the Fed is the grand illusionist, pulling the levers behind the curtain. Doesn't fall apart. How does the Fed work its magic? Prepare to have your mind blown. The Fed doesn't actually print stacks of cash and airdrop them onto Wall Street, though that would be pretty cool. Instead, they create money electronically, with the click of a mouse and a few keystrokes. It's like magic, but with more zeros and fewer doves. Here's the gist. The Fed buys up government bonds, fancy IOUs from Uncle Sam, from banks. But instead of paying with actual money, they simply credit the bank's account with newly created digital dollars. Poof! Money created out of thin air, like a financial rabbit out of a hat. This new money, now in the hands of banks, is free to be lent out to businesses and individuals, increasing the money supply and hopefully stimulating the economy. It's a delicate balancing act, and the Fed has to be careful not to overdo it. Too much money creation can lead to inflation, and nobody wants to pay $100 for a gallon of milk, except maybe dairy farmers. So the next time you hear someone say, the government just prints money when they need it, you can set them straight. What secrets does the Fed hold? It's not quite that simple, but it's still pretty wild when you think about it. Money, as it turns out, is more of a shared illusion than a tangible thing. And the Fed is the grand illusionist, pulling the levers behind the curtain. What are the dangers of uncontrolled money creation? Remember that delicate balancing act we talked about earlier? The one where the Fed tries to keep the economy humming along without sending inflation into overdrive? Well, sometimes things go wrong, really wrong. When central banks create too much money too quickly, it can lead to inflation, devaluing everyone's savings and eroding purchasing power. Remember those $100 gallons of milk? Yeah, that's hyperinflation, and it's not pretty. But it's not just central banks that can destabilize the system. When banks get greedy and make risky loans, it can create asset bubbles that eventually burst, leading to financial crises and recessions. Think the 2008 housing crisis, but with potentially even more disastrous consequences. The problem is, the current system incentivizes both risk-taking and excessive debt creation. Banks are rewarded for making loans, regardless of their quality. And governments are often tempted to inflate their way out of economic trouble, then increase taxes on their citizens, and already national debts are exploding beyond historical proportions all over the world. This is why Ray Dalio, founder of Bridgewater Associates, has issued increasingly urgent warnings about the trajectory of U.S. and global debt, arguing that the current path is unsustainable and could result in fallout far more severe. We've borrowed our way into a corner, and unless we start dealing with the debt problem soon, the fallout could be much worse than a typical recession, potentially lead the country into uncharted and risky path. How can we prevent these dangers? It's a recipe for disaster, a game of musical chairs where someone is always left standing when the music stops. So what's the solution? Can we escape the debt trap? How do we fix a system built on such shaky foundations? What are the solutions to the debt trap? That, my friends, is the million-dollar question, or maybe the trillion-dollar question, given the current state of things. Some argue for a return to the gold standard, tying the value of money to a tangible asset. Others believe in alternative currencies, like Bitcoin, that operate outside the control of central banks and governments. Still others propose radical reforms to the existing system, limiting the power of banks and promoting greater financial transparency. The truth is, there's no easy answer. The future of finance is uncertain, and the stakes couldn't be higher. But one thing's for sure, we need to start asking tough questions about the way our money is created and controlled. Because if we don't, the consequences could be dire. So the next time you hear someone talking about the economy like it's some abstract concept, remember, it's not. It's people. It's businesses. It's the very fabric of our society. And the way we manage our money has a profound impact on all of us. At the end of the day, it's our creativity, our hard work, and the way we lift each other up that make life truly extraordinary, meaningful, satisfying, and enjoyable. Let's not lose sight of what really matters or fall into the trap of chasing money for its own sake. Money is just a tool. It's meant to support our dreams, not define them. So let's stay focused on making a difference, building something meaningful, and helping each other thrive. If we keep that perspective, we can't go wrong.